Well, thank you, Rob. I don't know about you guys, I thought that was pretty upbeat, actually. But now that I'm here, it gets even worse. I'd like you to take a look at this picture and tell me what you see. All right, so how many people see the very attractive woman? How many people see the very ugly woman? Yeah. Okay, so that means you're all schizophrenic. This is the way you could actually describe the markets. There is, on the one hand, on the other hand, issues related to almost all the investment things we look at. Many doom and gloom issues, many positive issues. So, for example, are we looking today at a bull market? Is it a bear market? Or is it something in between? Is it the cowardly lion market? Now, just before I go in there, a lot of you know that I'm a real trivia buff. So there's a free John Malden. He's just issued his new book, just came out today, for the first person who can tell me who this actor is. Who said Bert Lahr? That's like 10 books. All right, if you guys all come up to me, we'll all get 10 books. That's well done. Thank you. An individual named Vitaly Kuznetsov wrote a book just recently, and I'm going to go over some of these books and just describe them. You may be quite interested in acquiring them. This is the Little Book of Sideways Markets. This is a very good active value manager from the U.S. I've got a chance to know him a little bit. He has a very, very good track record, and he's trying to describe this environment that we're in and we've been in. He doesn't talk about bull and bear markets. He talks about bull and sideways markets, markets where essentially they go up and down and up and down and up and down for 5, 10, 15, and in his opinion, in this case, 20 years. From 2000 through 2020, serious traction. Now, why would this happen? Well, let's just use an example, one of the ones that he uses. You're looking at a picture of the stock price of Wal-Mart from 1999 to 2010. And Wal-Mart is one of the largest companies in the world, most successful financially, yet its share price did not change in basically 11 and a half years. A lot of noise, not much action. But if we took a look at how the company performed financially, what we find is, in fact, the company's profit went from $1.25 a share to $3.42, or up almost 11.5% a year for 10 or 11 years in a row. Now, what kind of investment would you make in a business which had that kind of growth and at the end of the day was worth exactly what you started with? Doesn't that not sound a little bizarre? Well, that's because in sideways markets, or what we'll call cowardly lion markets, there's another factor, and that factor is price compression. In 1999, people paid 45 times earnings to buy Wal-Mart. Today, they're paying about 14. So every time the earnings went up, the multiple on the earnings went down. And as a result, the price did not change. So what happens in markets like this? Well, if you're trying to earn a return on equities by simply buying and holding on essentially very well-run companies, by itself, that simply isn't going to get the job done. Proof of that is that the S&P 500 is still below where it was in 2000, and if you're a Canadian investor, it's about 40% below where it was in 2000, 10 years ago. So the issues are, to make money in equity markets, you need to sort of have the wind behind you. That means you need low price-earnings ratios to start with. You need dividends and dividend growth. You need to be able to write, call, and put options. This is a strategy that we've been doing for quite a few years. And finally, there are other asset classes, and David really pointed this out. There are so many other asset classes to consider that this is an important one, but it's certainly not the only one. So just remember, from an equity perspective, our view of the next 10 years is not that we're going to see some buoyant, exuberant market take us forward with large future capital gains. It's certainly not our expectation, and it's not how we plan on generating a return. So I want to share with you some other books. This is a book that recently came out by an economist in the U.S. called Gary Shilling. It's called The Great Deleveraging, or The Age of Deleveraging, I should say. And his views are completely contrary to what most people would think, but he has an amazing track record. So So he's a well-known economist. He's done extremely well in predictions in the last 40 years. He believes we have a decade of deflation ahead. So in order to buy this argument, what you're really saying is the U.S. will get its act together. It will figure out a way to reduce its deficit. It will do so by reducing its deficit and then ultimately reducing its debt, as will its consumers. And all of that is deflationary, as has occurred in Japan for the last 20 years. If he's right, he has these favorite investments, and one of them at the very top is 30-year U.S. bonds. So he is seriously investing significant money buying long-term 30-year bonds at 4.7%. He believes that they'll go to 3% within the next 2 or 3 years, and when they do, he will make a minimum return of 15% a year on his outcome. On the other hand, of course, if they go to 7%, he'll lose the same 15% a year. That's the kind of bet that this is. In the other areas, it's interesting. We agree on things like rental housing, dividend-paying stocks, North American energy, and healthcare. He is very bullish on the U.S. dollar against the euro. I think he might have a decent argument there, and I'm going to look at that when we look at the debt situation in Europe as well. Here's another view from a Canadian. So this individual wrote the book, The Great Reflation. His name is Anthony Beck. He used to be the CEO of the Bank Credit Analyst, which is very well respected. He's also got a great track record. And he thinks we have a decade of reflation. But at his predictions, outside of the inflation-linked bonds and the fact that he's pro-Canadian and Australian currencies against the U.S., he likes U.S. versus Canadian real estate, dividend-paying stocks, and energy and commodities, the same choices as Gary Shilling. Interesting. John Malden, who spoke to us last July, is a well-known author. Some of you subscribe to his newsletter, and you know his new book just came out. Apparently, I owe some people here 10 copies of it. And it just came out yesterday. It's a really good book about his belief of what the end game is, the end game being what's going to happen with all of this debt. So he's been writing about this and talking about this for some time. And of course, he looks at the U.S. situation as being problematic. I don't think it's as problematic as some countries. But this is the total U.S. debt position in the U.S., including private debt, and how it's escalated like a hockey stick. And at some point in time, he says, countries have to make changes in these outcomes. They cannot sustain them indefinitely. One of the other issues, of course, is entitlements. This is from a graph we used last year. What you're looking at in the red is the actual debt to GDP of these major countries. What you're looking at in the gray is the debt to GDP if you present value all the promises and commitments they've made on pensions and healthcare. So essentially, on average, it's about 500% of GDP, and so far beyond the pale that there's no way that this can be guaranteed. It's 4 to 5 times the official government debt for virtually any country in the developed world. So this cannot be afforded, which simply means when something can't have happened, then it won't happen. And if it doesn't happen, the only question we're asking ourselves is, well, what will replace it? What will change? And we have to seriously expect massive changes in the way we fund healthcare, the way we pay for healthcare, the way that pension liabilities are dealt with, and we're just beginning to see the issues here. It's interesting in the U.S. how Obama, and not just Obama, the Republicans as well in Congress, have not had the intestinal fortitude to deal with the deficit issues, but so many state governors have actually stood up to the plate and started to seriously deal with the issues. Because what they're finding is that, in fact, there is a limit to borrowing, and the markets are telling them that they've already reached it. So last year, we wrote a couple of newsletters about this from a European perspective. We wrote this newsletter called If Pigs Could Fly, and it was referring to the situation in Greece at that time. We remember my big fat Greek wedding. We just changed that word to debt, and we were looking at the massive amount of borrowing in Greece in particular, and our favorite European oxymoron, which is a Greek taxpayer. And now this whole issue has transferred itself to Ireland, and not just Ireland, and now we have this when Irish bonds are falling. So Ireland has got itself into a real mess because its government, its former government now, made a decision to guarantee all the debts of all of its banks. They probably made that decision in kind of a rush because they really didn't have any idea what they were looking at. So what you're looking at here is the issue of 10-year government bond yields. You'll see that Germany, typically down here, is paying roughly about 3% to borrow money for 10-year bonds. Even though it's in the same currency, Greece is paying 12 and Ireland is paying 9. So sort of think about it from an American perspective, what this sounds like. It's like, okay, well, if you're from California, it costs you 12% for your municipal bonds. And if you're from South Dakota, which has no debt, you're basically paying 3. So everybody moves to South Dakota, notwithstanding the weather. The other problem that Ireland had was its deficit. This year, 32% of GDP. Now, 32% of GDP, we throw these numbers around. They don't necessarily mean much. So let me try to put it in a Canadian perspective. We're going to have this year probably end the year with about a $40 billion deficit. If we had a 32% deficit, our deficit would be $550 billion this year alone in Canada. So if you want to get some sense of this Irish situation, that would give you it. And the bottom line is very simple. Neither Greece nor Ireland, and for that matter, realistically, Portugal, can afford to pay either the interest rates that they've got or the actual principal of this debt. Therefore, something's going to happen. Some deal is going to be cut. Somebody's going to take a beating on those bonds, if they haven't already. So this is a situation that's occurred in Ireland. You have the IMF saying, holding them up to take the money, and then you've got the EU saying, the next one's on me. Why are these global organizations so desperate to give money to the Irish? I mean, besides the fact that they make a good whiskey and they have a decent beer. I mean, but what other reasons would they have for doing this? Well, you have to go back to find out who actually lent the money to the Irish in the first place. This is a chart of a number of countries: Greece, Portugal, Ireland, Spain, the US, and the UK. And this is a map of Europe. And we'll pick on one country in Europe, Germany, and see how much German banks have lent these other countries. And in particular, we can look and focus a little bit on Ireland. German banks lent $183 billion alone to Irish banks, which is now guaranteed by the Irish government. So why would the Irish government now, the new Irish government, say, let's make our people suffer so that the guys at the Irish bank don't take a hit on their bonds? Or do we really care about those German banks? Well, this is the new prime minister in Ireland. His name is Ed Kenny. And he's going to be coordinating himself with the Labour Party in Ireland to form the new government. And he's haircut. And he's not talking about himself. He's talking about those German bankers. And he's going to make a new deal with the European Central Bank, and we're yet to see what that deal is. But that is important because it's the beginning of what may play out to be very important for sovereign countries to see what occurs in these discussions. We'll call them Co-Canaries. So you've got these countries, in particular the ones in danger right now, Portugal, Ireland, Greece. They're the canaries in the coal mine. And it's my opinion that when we see how this all plays out, because this debt can't be repaid under the terms and conditions that exist now, then we will get some sense of how the markets in the long term will view countries like the US and maybe before that, Japan as well.